Have you ever found yourself staring at your screen, pondering the age-old question for DIY investors, M1 Finance versus Vanguard, which one truly takes the crown? If you're a long-term investor, someone who believes in the power of compounding and letting your money work for you, then this video is precisely what you need. We're about to deep dive into two of the most prominent platforms for self-directed investing, dissecting their features, fee structures, investment philosophies, and overall user experience to help you decide which one aligns best with your financial goals. For years, Vanguard has been the undisputed champion of low-cost, passive investing, synonymous with index funds and a client-owned structure that truly puts investors first. They've built a reputation for simplicity, efficiency, and a no-frills approach that resonates with those who want to set it and forget it. On the other hand, M1 Finance has burst onto the scene with a disruptive model, combining elements of a traditional brokerage with the automation of a robo-advisor. They offer something uniquely customizable, allowing you to build a portfolio of individual stocks and ETFs, then automate its management with their innovative PI system. So, are you a traditionalist who values time-tested principles and a proven track record, or are you a modern investor seeking more control and a highly automated, personalized approach? That's the core question we're addressing today. By the end of this comprehensive comparison, you'll have a clear understanding of which platform is the superior choice for your DIY investing journey. Let's begin by looking at the core philosophies and target audiences of each platform. Vanguard, founded by the legendary John Bogle, is built on the philosophy of passive investing, low costs, and broad market diversification. Their primary aim is to help investors capture market returns by investing in low-expense index funds and ETFs. This makes Vanguard ideal for long-term investors who prioritize simplicity, cost efficiency, and a hands-off approach. Their target audience is often those just starting their investing journey, or experienced investors who understand the power of passive strategies and want to minimize fees. Vanguard emphasizes long-term wealth building through broad market exposure, without the need for frequent trading or complex portfolio management. If you believe in buying the whole market and holding it for decades, Vanguard is your historical ally. M1 Finance, in contrast, caters to a slightly different, though overlapping, demographic. While also promoting long-term investing, M1 Finance appeals to investors who want more control over their portfolio composition but still desire automation. Think of it as a hybrid. You get to pick your specific stocks and ETFs, but M1 automates the rebalancing and investing of new deposits. This makes M1 Finance particularly attractive to sophisticated investors or those who enjoy building their own custom portfolios, perhaps based on specific themes, dividend strategies, or ESG principles. Their target audience often includes individuals who are comfortable with a bit more customization and want to express their unique investment ideas while still benefiting from automated management. Now, let's talk about the bread and butter of any investing platform, investment options. Vanguard offers a vast array of its own low-cost mutual funds and ETFs, which are arguably among the best in the industry in terms of expense ratios. You can access a wide range of asset classes, from broad market index funds covering U.S. and international stocks and bonds, to more specialized sector-specific ETFs. They also offer individual stocks, bonds, CDs, and options trading, though their strength truly lies in their proprietary funds. If you want to invest in a Vanguard Total Stock Market Index Fund or a Vanguard S&P 500 ETF, you're getting some of the lowest expense ratios available anywhere. However, if you're looking to invest in specific individual stocks or non-Vanguard mutual funds, the options and fee structure might be less competitive. M1 Finance offers a different kind of breadth. While they don't offer mutual funds, they provide access to over 6,000 individual stocks and exchange-traded funds, ETFs, including over-the-counter, OTC, securities and even cryptocurrencies through M1 Crypto. This extensive selection allows for significant portfolio customization. The beauty of M1 lies in its PI system, where you create a visual representation of your portfolio, dividing it into slices for different investments. Each slice can be an individual stock or an ETF, and you can allocate precise percentages to each. This gives you a high degree of control over your asset allocation, letting you truly express your investment philosophy. For instance, you could create a growth pie with tech stocks and growth ETFs, or a dividend pie focused on high-yield dividend payers. M1 also offers pre-built expert pies if you prefer a more curated approach, covering various themes like responsible investing, retirement, or income generation. Next up, let's tackle fees. This is often the deciding factor for many investors, and both platforms have distinct approaches. Vanguard has long been celebrated for its ultra-low expense ratios on its mutual funds and ETFs. Their unique client-owned structure means profits are returned to investors in the form of lower costs. While they have minimum investment requirements for some of their mutual funds, often $3,000 for Admiral shares, their ETFs can be bought for the price of a single share. For general brokerage services, Vanguard offers commission-free trading for stocks and Vanguard ETFs. However, for options trading, there is a $1 per contract fee, which is higher than some competitors. Certain non-Vanguard mutual funds might also incur transaction fees. Overall, Vanguard's fee structure is designed to be highly cost-effective for long-term investors primarily using their own funds. With that said, thanks for watching and until next time.